Yeah.
Stan, are you in Florida?
No, I'm not. I'm in Pennsylvania. I'm getting ready to babysit my grandchildren for the weekend.
Mine is in the other room.
Nice.
Good for you.
Well, you get duct tape and you attach them to the wall. It helps.
Well, I'm okay with any two of them. It's when the three of them gang up on me that I get in trouble. So that might be good advice. If I put one on the wall, I can manage the other two.
Right. Yeah. Or put them in the car. Forget the baby seat stuff. How old are your grandkids?
3, 6, and 9.
All right, they're older than baby seat kind of stuff.
Eh, you know how mothers are. And mine is a daughter-in-law, which means that I have no say at all.
Rich, you have that to look forward to.
I know. I got one in college and my girlfriend and I, and then we have senior, junior, sophomore in high school. So I got a lot of college bills coming up and less teenagers in my life eventually. But yeah, I'm in that phase of life right now. So
Interest rates are going to be a little lower next year, so maybe you can wait to get that home equity loan.
right, exactly. Yeah, definitely gonna wait on that a little bit. So
We heard it here first.
you heard it here first. All right, let's go ahead and get into it. This is the big picture. I'm Rich Swerbinsky with Onward and Upward Consulting, and big picture presented by our friends and sponsors at Depth. 20 years of very ably serving the fintech and mortgage markets, strategic communication, public relations, brand management. Do a great job, Carrie Milam and the team at Depth. You can check them out at depthpr.com. And yeah, I want to start out by thanking our friends and partners at Depth. And as always, joined by my esteemed colleague and co-host, Rob Krisman. Rob, how you doing today?
I'm doing well.
Doing
Doing
great.
well.
And this week,
Stan, I was babysitting my granddaughter this morning. So
Yeah, I'm resting up and getting ready to roll.
yeah.
and this week's special guest on work and grandparenting duty. It is the founder and CEO of Freedom Mortgage, Stan Middleman. Stan, thanks for coming back on the show.
Hi, nice to see you all again.
All right. It should be fun. No shortage of things to talk about and all kinds of news in the world of mortgage lending. But I want to start by just noting in the chat Stan's new book, Seeing Around Corners, Achieving Success in Business and Life. Kind enough, a couple free audio versions of the book. We put the link and two codes in the chat. So first two people to redeem those codes at audible.com can get free copies of Stan's new book. And Stan, what's it like being an author? It's been what, 5 months now? How's that whole process been like?
Well, so that's interesting. I think I spend more money going from place to place to talk about it than I make on the book. So I would not say that this was a wonderful economic move on my part. But it is fun and it's interesting, and it took me to a different place. I get to carry conversations with people that are more interesting, you know, for people that I didn't know previously. So I'm getting to meet a lot of people. I'm going to a lot of places. We were, I think, like one of the best-selling financial books at Amazon. So we got a little label or certificate at the corner of our website, which I guess is pretty thrilling in some respects. But you know, aside from the fact that I get to meet all these people and carry these conversations. One of the really nice things about it is being able to spend time with my grandchildren. And when I go into each of their rooms, they have a book on their shelf with a picture of me staring right out at them. And that's a pretty cool thing when I get to go to their house and see that it's important to them, you know, with their favorite things, their little car, their stuffed animal, or their snow globes, all their favorite things are right there with a copy of my book, which is probably the most gratifying thing about having written it.
Well, it sounds pretty gratifying. And to have memorialized you, great career as a businessman and an entrepreneur, and to be able to pass along some of those learnings, some of the, advice and lessons learned along the way, the Freedom Mortgage Journey. 1990, Stan, was when the company
Yeah,
was founded?
35 years.
Wow. Any big plans for the 35th year? Are you going to have like Springsteen at the MBA annual or something this year?
Well, we have our annual leadership conference coming up in Atlantic City. And that's always big doings for all the top leaders at Freedom. We probably bring 1,000 people in. And I think we will have Megan Trainor this year in April,
Okay.
the leadership conference. And I think we do have big plans for the MBA National, which I think is in Las Vegas, if I'm not mistaken.
Mhm.
And I enjoy a good concert, so I think that you can count on me producing again a pretty
Nice.
good concert there. And if you want to join me, I think you'll have a pretty good time.
You don't want to break the news here on the big picture. You still got to keep it under.
Yeah, I think I'm going to keep it in my pocket a little longer.
All right, that's fair. So, all right, well, Rob, as always, I mean, I feel like last year it was we were just talking about like the slug of the market, and there wasn't a ton of news to drive the open of the show. Quite the opposite these last few months. Certainly, no shortage of news moving the mortgage markets, but I think this week it's been the tariff stuff, the volatility of rates, bond market rallied. Initially, it's bled off a little bit, but your thoughts on, the going-ons, I guess, Rob, of this past week and the tariff-related stuff and how it's affected mortgage rates.
Well, you can't. We're in an environment where if I do X, somebody will say, "Oh, he did X," and somebody else will say, "Oh, he did Y." The traditional economic thought is a tariff is a tax. The tax is passed on to the consumer. It's either inflationary or the consumer doesn't like the new price, and doesn't buy it. I mean, that's really it, basically. When you, I think we saw how the market reacted earlier this year, right after the January 20th, and then in February when President Trump was going to put the tariffs on and took them off, and the market did X or Y. Now they are on. And then I forget who it was the other night said, I think it was the Commerce Secretary or Department of Treasury, some Secretary of Treasury, somebody said, "Oh, well, we could change all that on Wednesday." And then I heard him on Bloomberg yesterday saying, "Well, I didn't say that." So there's a lot of confusion out there with regard to tariffs and with regard to what impact they may have on the economy. But in general, I think that we are going back to Trump administration one, to Trump one, where people wake up to what was tweeted overnight, and do they react or not react? And it's not it's not an environment for the faint of heart. And the capital markets, I mean, I've been doing capital markets for nearly 40 years. That's my background. When I talk to capital markets people, they just kind of shrug and say, we just take it one day at a time and hedge our pipelines and just do it day after day after day, and certainly don't try to speculate on the market. But you're right. In the last week or so, rates have come down. because the thinking is that the tariffs will and other measures will impact the economy in a slowing way. And I've certainly heard a fair amount of stagflation bandied about lately. I haven't heard that term for a while. And so you could have an environment where, with the price of eggs, what they are, or cocoa, what it is, or whatever. And if the economy is slowing, there could be a stagflation environment. But for right now, I think people are just kind of so wary, wary, or maybe weary is the better term. But about with the headline news, it's tough to really think about where interest rates are going in general. I think overall, though, if the ECB just cut rates today, I think the thought that our Federal Reserve is more inclined to cut rates at some point this year, whether that's once or twice or three times. I think that thinking a month or two ago when you had people saying, oh, the Fed may even raise rates, depending on if the economy is doing well. So it's just kind of just people are doing what they're doing and not trying to predict interest rates. So Stan, I hope you're right. Hope interest rates come down a little bit. I think the MBA is predicting rates will come down a little bit. Mortgage rates in the 6s or 5s would be great. But yeah, it's one day at a time with this administration. You just don't know what's gonna be said.
And to that point, Rob, just breaking about an hour ago, the tariffs now are off again. They've been delayed a month on most products from Mexico and expected to follow suit with Canada. So on again, off again. Stan, your general thoughts on just, I guess, it's been a lot of noise, a lot of news, a lot of action in the real estate finance market these last few months. As the leader of now by the way, the second biggest mortgage company in America saw the release 122 billion last year, Freedom, and you guys passed.
But the most important, I think
And you passed Rocket, so you guys are the number 2 mortgage lender in the world. So how does the fearless leader of the number 2 mortgage lender in America, just view all this?
Well, so that's by origination, which is nice, but not really all that meaningful. I think there's a lot of things that can influence originations. It's better to be 2 than 12. But that would be the way I would think about that. I want to kind of go back to Rob for a second, because I think there's some important points that he came up and mentioned that I think that need to go into context. And it's secondary guys, God bless them, they have the hardest job in the world because they have to predict things in the short run, which is virtually impossible to do. Because you have to, we live in such a complex world in such a complex society with so many drivers that somebody can get gas in the Middle East and it's going to impact interest rates in America. And I don't envy those that have that job to do. And that's why we try to break even in secondary. If you're trying to make money, you can go to the casino if you want to gamble. But the stakes are too high, and that's why I don't gamble. In the mortgage business, the stakes are way too high. And that's why I think gambling is a little boring because the stakes are so low. But you can't gamble when you're talking about really, really big dollars. And I think that as what'd you say, second leading originator? I guess that means we're doing 10, $12 billion a month. And that's just too much money to gamble with. So our goal in secondary is to break even. We don't have to be right or wrong. We just have not to be wrong, right? We have to make sure we're not really wrong. And we're playing for that break even. So let's talk a little bit about the economy and the administration, how that all fits together, because I think it's interesting. I think tariffs are part of a broader agenda to drive, I outcomes beyond the direct economics of them. I think they're a tool to other means rather than just the economic consequences. And I think that's always been the case. And historically, tariffs haven't been something you want to marry. In the analysis that I've seen, the expectation is through the course of the year, we don't expect tariffs to have much of an impact at all. In fact, I think they're not going to have the opportunity to be deflationary. In the worst case scenario I saw was a 1% change to GDP. Even in that environment, we're not expecting that to be an overwhelmingly crushing thing. Now it's a big percentage of GDP, but it's just not a big number. I think the more interesting perspective is really oil. I think we're going to see lower oil prices, and you've heard Trump talk about trying to drive the price of oil down. And I think the price of oil coming down, which permeates every crevice of our society and has a huge impact on the economy. And I think that can be a driving force. And if we did become more insular, I don't know that it would really hurt our GDP. The layoffs, and I think the interesting thing that really is really interesting is how much impact do those layoffs have on other sectors of the economy outside of government. And if you combine higher unemployment with some lower oil prices, I think that you can add in a little bit of a shaker of AI to drive efficiencies. I think we might be more disinflationary than we are inflationary. And I think that given the chance to play out, I think that's going to take us to slightly lower interest rates. I don't think that we're set up for a big recession. I don't see an inverted yield curve on the immediate horizon. I think we've got, a lot of stuff going on. So when I talk about lower interest rates, I'm thinking about moderately lower interest rates. I think if you see a 6% or a 5 3/4% mortgage rate, that would be low. I think you see 360, 350 in the 10-year. That probably feels right to me. But I think you also are going to see property values go up if interest rates come down. And that may offset some of the disinflation you otherwise would find across the broader economy outside of housing. And at the end of the day, when you mix all that stuff together, I don't think we're going to see the residential finance business for homes change a whole bunch from previous years. Remember, we were really low. I think we did $1.9 trillion last year. And if that improved by 25% or 30%, it's still not a very big number. If it improved by 50%, it's not an overwhelming number. So, and I don't think we're seeing a 50% change, by the way. But could I foresee a 2.2, 2.3 in 25? Yeah, I think I could see our way to that, maybe even 2.4. Which would be a big improvement in terms of originations. But I don't see something that's massive happening in the near term. Now I think you'll see a little more take hold next year as things start to become clearer. And 26 will start to come into focus during the year. And I think we'll get a pretty good idea where the world's going then.
Good stuff. And obviously a lot of changes with the housing agencies in DC. The CFPB looks like it's going to be kind of reduced to, a shell of its former self. John McKernan, I think his nomination hearing is today, if I'm not mistaken, his official one. But any thoughts about the goings on at the CFPB, how that could affect, could help mortgage lenders potentially, maybe how it could negatively affect consumers? Your thoughts on those developments?
So I don't want to be political, but I will tell you that we had a very zealous group that weren't focused on consumer harm. They were focused on a broader agenda. And they were truly acting in an ideological fashion, trying to advance an agenda that was ideologically based. And I have to warn everyone to be wary of zealots. And I think we can go back to your little pun, it could be weary of zealots, but we need to revert to the mean. I think that the rise and the overzealous behavior of the CFPB in the previous bunch of years, and the reaction of eliminating it virtually, or making it ineffective, or neutering it, whatever you want to call it. The other way may have been a little bit too far, because we need definition and rules. The one thing that really makes our industry such a wonderful place is it's inhabited by companies that are really good rule followers. And I think that, my prejudice is being allowed. I think that residential mortgage lenders as a group, whether it's banks or independent mortgage companies or savings and loans, if there were any, or commercial banks or credit unions, are really good rule followers. I mean, if there is an expertise that we have, it's being a good rule follower. And consumer harm is at the top of the rules that we don't want to violate. And I don't think that I've seen anybody move in bad faith. I don't think that there was any malicious behavior by our industry towards consumers. And most of the activity that came out of the CFPB in the most recent years has been agenda based. It hasn't been consumer harm based, which leads me to believe that they got a little far afield of their mission, was to make sure that the consumer was treated fairly. And I think they started out doing that. I think when they came out of Dodd-Frank and began their mission, that they were concentrating on consumer harm, and I think they had good reason to behave that way. But I think advancing an ideological agenda with the zealousness that they did was probably overplayed. And elimination is probably overplayed as well. There's nothing wrong with a good regulator that helps you do a good job to take care of the consumers and to do your job right. And strong, sound institutions that are responsible and behave with a social conscience are necessary in our society. And the good news is I think that our society is inhabited by those kind of lenders. I'm really proud to be part of this industry. We do so much good for this country, and we help people build wealth in their homes and to own a home. But we can't control the factors that are tidal in our economy and in our environment, and nor should we. And people are going to get foreclosed, particularly if the credit windows are open so wide that it allows everybody in. You have to have a certain set of criteria to qualify as a homeowner. And I think those criteria shouldn't be neglected or overlooked or underused.
Rob, the CFPB issue, it's such the industry's all over the board on it. Certainly a lot of people that are like, oh my God, thank God, get rid of them. Others that are like, this is horrible for the industry. We need a regulator. You heard Stan kind of talk about both sides of that argument. And Rob, you talked to probably more people than anybody I know, just your travels across America and obviously the correspondence you get back from your daily commentary. What's your sense of where the broader industry is at with the developments with the CFPB, Rob?
Well, the CFPB and all regulation, frankly, I haven't received any word from any owners and CEOs saying, "Oh, good, we can do away with fair lending and RESPA and TILA and go back to taking applications on yellow legal pads and so on." Uh, I have heard from minor players out there uh, asking about point banks, for example. When is LO comp going to change? How's it going to change? And so on. Uh, and I tell them, I don't know if it's going to change or not. And I remind people that many of the rules and regulations that we had in place were in place before the CFPB came along. And so, keep that in mind. Now, people should also keep in mind that many of the things that have been implemented have been uh, implemented to the benefit of people who invest in our product. We're manufacturing mortgages, and this is the message I've been spouting for quite some time, is that investors have a comfort level with the ability to repay, with the thinking that, gee, if they say that house is worth $400,000, then that house is worth $400,000. So they have that comfort when if you're a portfolio lender or investor, or you're an MBS investor, money manager in Tokyo or whatever it might be, you have comfort that even though there isn't necessarily an explicit government guarantee, that the mortgages that you're buying, the borrower has the ability to pay back the loan, and the property is what it is, and so that it's a good loan. And so nobody, I think, in our industry wants to go back to having investors wonder, gosh, is this really what they say it is? Or being entirely dependent on the rating agencies, for example, who, certainly shared in what happened in 2008, 2007, 2009 with some of their rating practices. So nobody wants to go back to that. But there is a fear out there that, point banks will come back, or that the CFPB, although its intent is good, will be so gutted that, you know, you can't, nothing will really happen. So there is that fear out there. But like I said earlier, none of the CEOs and owners have written to me, or who I've spoken with are ready to dash back into the Wild West, um, which says a lot about our industry. To Stan's point, is that, we do a good job, and companies out there just want a level playing field. Tell us the rules, let us do it. We need, better regulation rather than more regulation. But it is nice having, believe it or not, I would say, Rich, the basic answer to your question is, I think that calmer heads have prevailed. They don't want the CFPB necessarily go away. If you're a multi-state lender, you don't want 50 little mini CFPBs nipping at you. A lot of companies
25 that
have.
want it this way and 25 that want it that way.
Exactly. Uh, they don't, a big investor or lender, they typically have an office or two set aside in their headquarters for when, Fannie Mae comes in to do an audit, or Freddie Mac or HUD or whoever, whoever. They don't want 50 little cubicles for each state coming in and pretending that they are the CFPB. So uh, I'm not saying that would happen necessarily, but I don't think anybody wants that. So as time has gone on, uh, I think the fear, we had that initial shock. Once again, this administration is full of shocks, right? Oh, we're gonna shut down the CFPB. I had friends, giving me their home email addresses, their non-work cell numbers, who work at the CFPB saying they're going to cut off my computer, they're going to cut off my phone. Here's my information if you need to get a hold of me, which is scary stuff. And that I don't think really helps anybody. These broad strokes, I'm gonna go down the political path here a little bit, but the broad strokes of throwing things against the wall and seeing what sticks, or claims of throwing the baby out with the bathwater, I think are warranted. You don't want to lay somebody off or lay off a group of people who are needed at FHA or at Ginnie Mae or at HUD or the CFPB. Uh, because the CFPB does, it does serve a purpose other than the enforcement. You look at the HMDA data that is compiled. You look at the APOR that is produced for compliance reasons that we need. So, you just have to be careful with some of the things, some of these big statements. We're laying off 70,000 people at VA. Well, really? Necessary? Uh, you just have to be careful.
Stan, Bill Pulte nominated for FHFA director. Seems like he's going to get through and ultimately, steer the GSEs on a path to privatization. We touched on this a little bit last time you were on the show, but your thoughts on Pulte and the potential privatization of the GSEs?
Well, I don't know Mr. Pulte. I know the finance company and the builder that came from his family, and certainly they've accomplished a lot. And he's been in and around the industry for a long time. So my expectations are at least he'll come in with a pretty good understanding of what he's dealing with. But maybe I'm giving him too much credit or too little. Because I really don't know the person, and I hate to have opinions about things I don't know. So that's on the individual. On the concept, I was talking to somebody that told me something that I thought was just the most interesting thing that I'd heard. And it was somebody that spoke to people in different countries and how people hate Americans. And he'd go to places and people would tell him that, gee, we hate Americans. But you know what? I'd rather live there. Do you think you can help me get in? I think people would rather live here than anywhere else because it really is a great place to live, and you have opportunities to do things that you don't have everywhere else. And one of those opportunities is a 30-year fixed rate mortgage. And one of the reasons we're able to do that is because of that guarantee of the MBS and our ability to attract investors. And I think Rob made a terrific point talking about investor confidence. The reason we didn't have a PLS for 10 years coming out of the crisis was nobody believed in our processes. There was no universal approach. There was no way to tell whether or not the securitization was good or it was fraudulent. Was it right or was it wrong? And we've worked for 15 years to win back investor confidence. And the proof is in the pudding. The PLS are trading strongly. We're getting great returns. Home equity securitizations are trading phenomenally well. And that's an indication of the health of our securitization industry. But the difference between that and the strength of a Fannie or a Freddie or a Ginnie is that guarantee from the government. I think it's got to be worth a point and a quarter, point and a half. And if they were not backed by the government, that would be different and it would cost more. And one of the great things that makes the ability to build wealth in this country is a home. And over time, even though you get corrections, and we're coming up on a point where we're due for a correction, and we're gonna, if you think about peak to trough, And the way you build up pretty significantly beyond the previous peak, almost always becomes the next trough. Um, that 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 thought, even though it's true, does not diminish the value of home ownership. And being able to live in a home at a certain price with the capacity to pay it off without a penalty, and without getting the wrath of investors, is an incredibly important and valuable thing that makes home ownership in our country more valuable than anywhere else. And I think when you think about the value of Fannie and Freddie and the stability it brought to the entire economy in the crisis, when the government stepped in and bought MBS, that's what straightened out our ship. The thing that righted the ship was the ability of the government to step in and buy MBS and truly guarantee those securities. And didn't happen in the private label securitizations. They went to crap overnight. The securitization market froze. We didn't have that, and the government did what they said they were going to do, and the economy got back to normal and began to roll after March 20th in 2020. And that confidence that the government instilled in the population, certainly in me and in my peers, there is absolutely no substitute for that understanding and that confidence. And as long as that confidence can stay in place, the way that the form that the GSE takes doesn't really matter nearly as much as that guarantee and that confidence that comes from knowing that people can own a home, live in a healthy neighborhood that's secure, where it's a safe place to live, and they can raise their families and build strong neighborhoods and strong communities and live in a place that they can raise their kids and live a happy life. And it's the pursuit of happiness that goes hand in hand with the quote unquote American dream of home ownership and being able to build wealth over your lifetime. And that's why what we do is so important and valuable. I mean, it's an incredible thing, the industry that we're involved in, the things that we get to do for people day to day. And we never even talk about or think about that. And I think every once in a while, it's good to reflect on what's your role in society and why are you here?
I love
I
it.
ask myself that every time I get up at 4 a.m., Stan. Uh, uh,
But you get up, don't you?
uh, I do. I do. It'll be interesting to see what happens if as things move forward, if we lose the GSE term, government sponsored enterprise, if that gets phased out somehow. So anyway, Rich, sorry
Well,
to
great
interrupt.
point, Stan. And yeah, and I mean, and Rob, and I mean, just something we take for granted, right? The 30-year fixed rate mortgage that is, yeah, kind of backed by the US government, at least for now. And yeah, the ability to pay it off without penalty, things that don't exist in other countries across America that we take for granted here, as well as the great work. I love your words just about the meaningfulness of what we do in this industry, because we've all watched. I mean, the perception of the industry since '07 and '08, it's come back a long way. Where would you say, Stan, like the broad like consumer um, perspective of our industry is, as I guess as it compares to '08 when it was, didn't have a great reputation. Do you feel like it's come all the way back?
Well, I'll tell you, I'll give you a quick story, which is kind of cute. I was at a comedy show in New York City. And the comedian says it happened to pick on me for no good reason. And he said, "What do you do?" I said, "I'm in the mortgage business." She says, "Oh, it's your fault." And then she went on about a 10-minute tirade about about and this was like '08 or '09.
Mhm.
So
It took guts to admit in a comedy show that you were in the mortgage industry in '08 or '09. I could see how that went sideways. Yeah.
yeah,
Yeah, I
it
mean,
got upside down.
I'm a stripper would be a safer answer.
Well, I would have been treated with more respect. But the reality is that I think that we earned what we got in '08. And I think we earned where we are today. And I think there was a lot of determination and a lot of conviction and a lot of money spent and systems built and technology created to put us in a place where I have a lot of confidence in the quality of the work that we do. Which is why I didn't like that zealot-like behavior, because I think it undermined how valuable the industry participants are. And I didn't appreciate that. It kind of made me feel like I was back at that comedy club every time I dealt with some of those folks. And I think that there's a certain level of respect that we do need to receive.
I've been saying for years, I think MBA is part of their budget. You know, you could say what you want about NAR. It's been far from a perfect organization. One thing they've effectively done, at least in my opinion, over the course of the last 20 years, is they've marketed like the value of a realtor in advertising campaigns and other methods. And, you know, you could argue how effective that's been, but you know, do you think something like that, especially as we go into this era where like the value of a mortgage professional in a climate that's still going to be affordability challenged, right? Your LOs at Freedom all across America are going to be working with aspiring home buyers, first-time home buyers to, you know, really pen the paper and make creative deals to get people into homes. Do you feel like any kind of like broad, you know, almost marketing campaign on behalf of like the industry and mortgage professionals is something that would have impact?
No, I think it's not the professionals so much. I think that if you carry yourself as a professional, I think subject matter experts are going to have a place. Stockbrokers certainly took their lumps over the years, and they were looked on badly every time there was a downturn. I think that lawyers certainly take some lumps in their advertising and their claims. If you read some of the jokes in Rob's column at the end, you know, he doesn't miss anybody through the course of a year. You know, you can make fun of anybody anywhere, and I don't know that it's the professional himself. I think it's the intent and the duty and the responsibility to do our job. I don't know that we see a lot of advertisements for firemen. They just go do their job every day. And I think that we should, kind of act like them and have I think there's a certain level of dignity and grace that does not pervade our society to the extent that it should. If we brought back a little more dignity and grace and pride in our profession, I think that we don't need to advertise. I think we just need to do our job.
Well said. This is The Big Picture presented by our friends at Depth. And we got a few minutes left with our special guest this week, Freedom Mortgage founder and CEO, Stan Middleman. Stan, you're also one of the owners of the Philadelphia Phillies franchise now for a couple of years, which is a huge baseball fan, fascinates me. And how has it been being an MLB owner? The coolest perks, and what's the Phillies? This is a veteran team that's kind of built and ready to win this year. Your outlook for the season for the Phils.
Well, I don't remember a March when I didn't feel good. So it's easy to feel good in March. But you could do a great job and assemble a terrific team and do everything that you thought needed to get done and fill all the holes in your lineup and fill out your pitching staff and be all ready to go. But you need two other things. One, you need to be healthy. And it doesn't take much to take a baseball player off his game. You lose 2 miles on your fastball because your back hurts or your elbow hurts. You're having a shoulder strain, and maybe you get a little bit of a tricep issue, and now you're not hitting the way you'd like to hit, and you're compensating and moving a little more to your left or a little more to your right, and that takes your timing off, and it's harder to reach that slider on the outside of the plate. You need to be healthy. And even these guys are warriors, and they don't want to miss a game. They don't want to skip an at bat. And they're going to fight through, and they're going to play at less than their optimal selves, which may be better than anybody else on the team, but may not be what you hope to. And then you get the guy in the stand tells them they're a bum anyway. That's the beauty of America, right?
Especially Philly
Um,
fans. I mean, are you a big Eagles fan as well, Stan?
I am.
Congrats. That was
I,
great
I had
run
a
by yeah.
great time there. And by the way, it was my mom's 90th birthday, and we took, I guess, 25 people with us, or 30 people, and it was just terrific. And the game was so much fun. So my mom got to be with her children and her grandchildren, and her great grandchildren, and see her Eagles play. And her favorite city's New Orleans, so she just enjoyed the whole thing. Um, and the Eagles accommodated too, so that was nice as well.
We
Uh,
won't bring up the Sixers because everything else is looking good in Philly right now.
yeah, it's okay. We can skip over that. I forgot that they still play. Um, but the other thing that baseball is really important is you have to be lucky, because you can be healthy and have a great team and just hit the ball 110 miles an hour right at somebody.
Right.
And you can do it, you can pitch great, you make one mistake in an hour and a half, and you can lose 1-0. So you need to be lucky, you need to be good, and you need to be healthy. And if we're lucky, we can talk again in September or October about how all those things turned out.
Well, we'd love to, yeah, have you back on the show and greatly appreciate your time today. As always, yeah, really, really appreciate your insight and outlook on the mortgage market, and really, really appreciate you taking some time to be with us today, Stan.
Hey, thanks for having me. I enjoyed it. It's always great to see you guys.
Absolutely.
You
And
too,
to
Stan.
our listeners and viewers, if you're listening to this on podcast or YouTube, we do the show live every Thursday at 3 p.m. Eastern. You can sign up for the live at chrismancommentary.com. And of course, this live version goes right to YouTube and podcast about 10 minutes from now after this show ends. So, but want to thank once again Stan and Rob. Thank you for, as always, being with us.
And depth.
And our friends and partners at Depth. And most importantly, those of you that take time out every week to be here with us on the big picture. And we will see you next Thursday.
Thanks for having me.
Have a great week, everyone. And thanks again, Stan.
Take care.
Take care.